Do you have a take on just the idea of putting a private investment, alts is often called, into a 401k? How do you see that playing out for retail investors generally, I would assume, who will be accredited investors? What's your take?
Well, look, I think we are starting to see the mainstreaming of private credit into portfolios. I mean, already affluent and wealthy investors have increased their investments in private credit by 2.5-fold in the last 3 years. There's something like about $350 billion of wealth assets now in private credit, but really that's still with the ultra wealthy. And so we're now seeing a lot of innovation, new funds, partnerships, and obviously some rule changes to explore bringing private credit into a range of other portfolios. And so far, it's been really exciting. You're seeing evergreen products growing at about 60% this year and continued demand. So I think that mainstreaming has actually got a long way to go. I think bringing it into retirement portfolios with 401k reforms is going to be really interesting. I think the firms we speak with have been concerned about litigation risk. And so it's really clear there needs to be sort of safe harbors or clear legal guidance, which may flow from this executive order. But I think that the legal backdrop notwithstanding, I think this is a very exciting area where people are looking for yield, they're looking for diversification, and private credit fills a role.
By the way, alternative asset managers, they're kind of popping on the news. We're showing them right now, a lot of them up right around 2%, give or take. I want to go back to banks trying to get into this business. So just for the audience's edification, private credit, it's basically, loans to riskier companies, often smaller companies, kind of a riskier portfolio for higher returns. So how do banks play in all this when they have kind of, restrictions on how much risk they can absorb? First, let's start off with them entering private credit. Can they be as competitive as some of these alternative asset managers? And then as they try to offer these alts to investors, will they be as attractive as the ones offered by these alternative asset managers?
Well, look, it's a great question. Look, this is a very broad market. And so there's some loans which fit better on a bank's balance sheet and some loans which fit better in a private market. If you think about it, given the financial crisis, the banks were discouraged from taking very risky loans, very long-dated loans, and very complicated loans. And so where private credit have really started, where it's grown in the last decade, has really been around leverage lending, mid-market lending. But in the last 3 years or so, fueled by money from the insurance companies, is much more long-term loans, which banks really struggle to hold, or jumbo loans, these really large, complex ones, again, where risk limits may inhibit a bank. So let's be clear, banks are going to be very, very competitive with private credit. But I think this is really more about where does a certain type of loan sit best? Who's the best owner of that risk? And I think the private markets have got plenty of runway.
When it comes to regulation, when we're talking about banks at least, do you see this current administration, essentially being more friendly and allowing looser regulations or maybe even carve-outs to allow big banks like a JP Morgan, a Goldman Sachs, et cetera, to get into this business and be more competitive with these alternative asset managers that have considerably less restrictions?
Look, I think the way to think about this is more about a rebalancing. At the end of the day, you want a financial system which allows credit to flow, to finance to flow, to fuel the economy. And inevitably, it's like having your heating system at home. If a valve is is too tight, then the heating system doesn't work so well. So I think there are some thoughtful recalibrations to help finance flow. Obviously, we're starting to see proposals for the leverage ratio. So in other words, the absolute size of banks relative to their capital be reformed so that banks can own some more government bonds. And that's obviously helpful for the overall economy. But I think at the very margin, there will be some recalibration which will allow the banks to be more competitive. But that said, as I said, there are some loans which just fit better outside the banking system. And that's why private credit is going to be a very good competitor.
I want to go over just the basic, the macro risk, if you will, right now. JP Morgan CEO Jamie Dimon also warning that this is becoming risky and could lead to a financial crisis. I know you used to advise Mark Carney, the governor of the Bank of England. Give us that perspective from someone who's been involved in central banks and the decisions they make. Is this risky? Is it worrisome just from an economic level that we're seeing this push into private credit and these riskier and riskier loans being sent out?
Look, I think all the central banks around the world are asking questions about this space. And I think it comes down to sort of three things. Like, first is there something systemic building? So is there an interrelationship between private credit and banks which should be troublesome? My take is that it's not the case. I actually think it's much more helpful to each other. The private credit firms are taking some of the riskier pieces, the banks therefore becoming less risky. But there's a systemic question that every central bank governor is asking. I think the second, though, is the cycle. Let's be clear, there'll always be a cycle. We're obviously, the US economy has been unbelievably resilient and taken all the punches of the last couple of years, particularly the higher interest rates and now tariffs, and that resilience. But nonetheless, they're paid to worry. And so they're worrying about where the cycle is going and to what extent private credit could play a role in that. And the third is you can never get rid of bad decisions. Like everything in life, there's some good decisions and some bad decisions. The key thing is life is the consequences aren't too great. And so they want to get more data. And so naturally, in a space which has gone from niche to mainstream quite quickly, they want more data so they can put their finger on the pulse. And I think that for central banks is a fair thing to ask for.